Alright, here we go. Capital assets and determining the cost by me, Todd Lawrence.
And me, Arusavan.
Alright, let's start. Capital assets.
Capital assets are long-lived assets acquired for the use in the operation of a business. They are not for sale to customers. Capital assets provide benefits over many accounting periods. They support production and sale of goods or services. So for an example, capital assets may include businesses, equipment, building, or computers that they use. So there are two types of capital assets. There's tangible capital assets and intangible capital assets. For an example, computer software would count as a intangible capital asset.
Alright, so tangible capital assets. Capital assets with a physical substance. Divided into two categories. Number one, property, plants, and equipment. Number two, natural resources. Unlike property, plants and equipment, natural resources deplete as they are used.
Cost of property, plant, and equipment. Property, plant, and equipment are recorded at historical cost, otherwise known as the original cost when it is purchased in accordance with the cost principle. Cost consists of all expenditures made to acquire the assets and make it ready for its use. So things like installments, painting, and legal fees would be recorded under the capital asset. Costs are capitalized, recorded as a capital asset, not expense, because they will provide benefits over time.
The cost of the asset becomes the basis for an asset for its useful life. The cost is the cash paid or the cash equivalent price paid. The cash equivalent price paid is the fair market value of the asset given up or received. Current market or replacement value are used when the values drop below net book value. If the capital asset market value falls below its net book value, an impairment loss should be recorded, reducing the net book value to its fair market value. Four classes of property. Four classes of property, plant, and equipment are 1. Land improvement, buildings, and equipment.
So land is the first one. The cost of land includes purchase price and other related costs such as legal fees and accrued property tax. Recurring costs are expensed against the revenues the land helps to generate. All costs which come from preparing land is also debited from the land account. In cases like demolition and removal costs, they are debited from land.
So land, here's just a little example. If land costs are $10,000, legal fees are $3,000, and warehouse removal costs are $6,000, land is debited $109,000.
So the second one we would like to introduce is land improvements. Land is a unique asset because you do not have to amortize it. Its useful life is unlimited. Costs incurred to improve land do not have unlimited lives. Costs like paving and fencing are recorded separately as land as land improvements. Land improvements are amortized over a useful life.
Buildings. Costs related to purchasing or construction of a building are debited from building. Interest costs incurred to make a building are also included after construction. Future interest payments used to finance the construction are debited from the interest expense.
So here's an example of building record. So if a building costs 150,000, roof repairs cost 500, and legal fees cost $2,000, buildings will be debited $152,500.
Equipment. Costs of equipment include cash purchase price and other costs like installation, painting, and assembling, etc. Licensing and insurance on a company vehicle are not included. So there we go. You have.
So for equipment, if a truck costs 22,000, painting and lettering the truck costs 500, the total of the truck will be $22,500. If the delivery truck license was 100 and the insurance was 1,500, the following shows what the journal entry would look like.
Basket value. Capital assets are often purchased as a group for a single price known as the basket value. We need to know the individual cost to calculate amortization, whatever. To determine individual costs by allocating the total price paid to each individual asset based on relative fair market values.
So if a company paid 150,000 for building and land, the land was appraised for 60,000 and the building 100,000. By doing the chart below, you can find the allocated cost based off of the fair market value.
Amortization. Amortization is the allocating of a capital asset to expense over its useful life. Amortization matches expense with revenue, follows the matching principle. It is a process of cost allocation, not asset valuation. Amortization applies to all capital assets except land because land does not wear out. The three methods of amortization are straight line, declining balance, and units of activity. Factors in calculating amortization. You have cost, the value of the asset, as well as the changes added to the value. Useful life, an estimate of the expected productive life of the asset. Residual value, an estimate of the asset's value at the end of its useful life.
So, capitalizing versus expensing. So to capitalize an asset is to report that the asset still has economic value that will benefit future periods, so it is put on the balance sheet. To expense an asset is to report that the economic value has been used up, so it is reported on the income statement.
So now if you ever want to try any examples, just go to the workbook, page 492, questions 256, or B10, 1, 2, 3, and E10, 2. That's all, folks. Alright, that was good. Oh shit, it's still recording. Oh shoot, I just took a picture and stopped it. There we go. Oh. How do I do this thing?